Good evening, everybody, and welcome. Firstly, a big thank you goes out to everybody who's taken the time to be part of this live webinar this evening. Also, if you're watching the recording via the player portal, then you're also very much welcome. Tonight's webinar is our final offering of our curriculum for 2024. It's been a record-breaking year with both content and viewing figures within such an important area of our well-being. Adrian and Mark, our friends and industry experts at Mattioli Woods, have been amazing supporters of our communities of people for a number of years now, providing game-wide financial wellbeing education. Tonight's webinar alone is the 10th in total that they've kindly delivered for us this year.
Okay, it's at this point that I'm just going to press on because I believe, Steve, if you can hear me, I think you've frozen on my screen. So I'm now going to press on and just say, again, good evening, everybody. Thanks for joining the live version. And if it's the recording you're watching, yep, thank you to you too. And this final webinar of 2024, as you can see from the slide, it's looking at the topic of saving and investing. Yeah, similar concept, but we'll try and differentiate between the two as we go through. And this is, again, part of your wellbeing program provided by Rugby League Care. So please take as much from this as you possibly can. Now, there are some legal bits that I'll go through now. They're kind of repeated at the end, but just from a final slide that I'll show you. But just to confirm that the information that we're going to go through is correct at the time that we're delivering this and the time that we've recorded it. And it relates to the 2024-2025 tax year. And you know, I can't believe it. It's November already. But anyway, we'll press on that front. The purpose of the webinar is very much focused on just the general topic of saving and investing, which is one of the essential elements when we come to any of the financial planning or sorting out our finances that we do. And I guess over the course of the next, 40 minutes maximum, could even come in a bit less, we'll look at why we should consider this as part of our overall well-being of a financial nature. Now, importantly, just to further clarify, apart from the tax year that we're working in, we're not giving financial advice this evening, but what we are doing is hopefully providing you more information around the topic of saving and investing, and I hope one or two ideas. So let's move on. I'm fortunately not on my own this evening. So Adrian, who you're used to hearing more often, is taking a well-earned rest on the sidelines tonight and will be handling any questions that you feel that you want to ask as we go through. So if you look on the right-hand side of your screen, you'll see a Q&A section. Please do use it. Ask Adrian any questions about the topics we're covering as we run through this. And then when we get to the last few slides, Adrian's going to join us to share any frequently asked questions, or it might be just one question, but it's an absolute corker that we really want to make sure that everybody gets to know the answer to it. Now, if you're asking a question and it's quite late on, and it's maybe Adrian and I already talking you through what questions asked, and a final one pops in, and you think, will I ever get an answer? You will. We will use the email that you used to register for the webinar, and we will get back to you. Now, those of you looking at the recording thinking, how does it work for me? Don't worry, there is a slide at the end. It's got my email address. Feel free to ask any questions, fire them through, and I will get back to you as soon as I possibly can. So let's move on and look at the topic of saving. It's quite different to investing, but we'll draw out the differences as we go through. But there's one thing I would say about saving, and it's certainly one I've felt personally. If there's no motivation to save, then we're unlikely to do it. So it really does help to know, okay, what the heck am I saving for? Now, to do that, you've got to have some sort of a plan in place. And I guess we've In previous webinars, we've spoken about having a financial plan and setting out objectives. Well, this is exactly the same. If we're saving money, what are we saving for? And if we know what we're saving for, it's helpful even further to think, okay, when am I going to need this money? Is it the next couple of years? Is it somewhere between the next, I don't know, 4 or 5 years' time? Or is it money that I'm going to need sometime in the future? Now, that helps on a number of bases. Number one, it helps us work out, okay, where are we going to put it? And the other thing it helps us do is what should we consider placing our money in terms of, should it be pure savings, or could I take a little bit more risk with the money? We'll develop that as we go through. Examples of what we might be putting money aside for. So you can see them at the bottom of the slide. And clearly, if we're looking for a holiday, well, that's probably going to be happening in the next 6 months or so. Whereas if it's retirement, if you're dialing into this or if you're listening to the recording, for you, retirement could be 30, 35 years away. I don't know. It's down to you and your plan. However we look at building up our savings or putting aside, longer term money, one thing's for sure, we've got to have a budget. We've got to know what money we've got coming in, and really importantly, what's the existing money going out. And if we're going to have a budget, it's very personal to us. Well, it's, first of all, the amounts are very personal, but the way we do it is personal. This is just a fairly straightforward example of what a simple budget might look for. So in this situation, you've got somebody earning 25,000 a year. They know what the income is coming in every year because they get every month because they've got a pay slip. Now, I appreciate your pay slip might look entirely different with other payments coming in outside of a base pay. But then it's things like, okay, the outgoings. Some of them we can't control. Things like the tax, national insurance, they're just going to happen. But things like pension contributions. Now, there's a great example of something that is very long-term savings. Okay, so that's something that all of us, and we've covered this in the past, that's something all of us should be considering. But there'll be things like it's either rent or a mortgage, there's running the household, there's insurances, they're not even on this list. There's running vehicles, there's all sorts of things in there. How much depth you want to go into is entirely up to you. But the important thing is to be on top of it, to know where the money is going. And also, and we talked about this on budgeting on a previous webinar, if there's a way of making that money work a little bit harder, i.e. shopping around and getting a better deal, then if you have the time to do that, and no question, it's going to be worth your time doing it. Now, you'll see that we've almost, on the example budget here, we've got almost £235 left each month. And that's a great amount to start beginning any sort of savings journey that you've got. And you might start thinking to yourself, well, hold on, what's the first thing that I should be considering on a savings front? Now, before we get into that, I'm going to ask you, if those of you on tonight, clearly you won't be doing this if you're watching the recording, but I really would appreciate those of you who are on tonight to answer me this particular question. I'm hoping that you're on your slide that you've got a poll that's popped up, and if it hasn't, then I'm hoping my colleague Adrian is very much posing the question for you in the polling section. The question is this, I hope it's popped up on your screen, and it's, do you currently have an emergency fund? Now, the answer to that is simply yes or no. You either have got one or you don't have one. And I'm going to pad around for about another 20 seconds whilst those of you who are dialed in are putting the answers in. Got to say, most of you have done a great job and you've got one, which is absolutely fantastic. But notwithstanding that, okay, there's a couple that haven't. Oh, okay, should we have an emergency fund? And I think the short answer is yes. It's a sum of money that you've got aside. You put it aside to cover the things that happen when, if you haven't got an emergency fund, you're going to be relying on credit to sort things out. So you're going to be putting it on a card, or you're going to have to borrow the money somewhere else. Having an emergency fund stops you having to look at that short-term borrowing that might cost you far more than you might want in terms of interest payments. So the emergency fund, it doesn't have any other purpose other than to be there when you need it. So it makes sense, therefore, to put it on a very easy access account. Okay, now, where should you start thinking about these easy access accounts? Well, you might as well ensure that you're taking all the tax breaks you possibly can by making sure that that money goes into tax-free savings. And for that, we're going to develop the theme by looking at individual savings accounts a little bit further on. On the slide, what you'll see is that, okay, we had about £235 left over. We're only saving £100 a month for out of the 235. So there's 135 left over to do other things or meet other needs. But you can see that over the course of a 5-year period, you can save a pretty significant amount that for many people will be the sort of amount necessary to put aside for emergencies and cover those one-off events that do happen from time to time. Now, I don't know if you listen to financial pundits on the radio or you watch them on the TV, all of them will recommend having an emergency fund. Many of them will suggest, well, if you've got something that will cover something like 2 or 3 months of your regular outgoings, that's a sensible figure to start with. I'd just underscore the fact that it is a very personal figure to yourself. So, you know, for you, if there's, I don't know, if there's a particular need in your part to have a higher figure, well, then just do it. If, however, you're thinking, yeah, that 2 months is absolutely fine for me, then go for it. It's whatever you feel comfortable with. Now, I suggested that you might want to consider individual savings accounts or ISAs to put your savings. Why are we suggesting those? Well, the savings are tax-free. When I say the savings are tax-free, it's the interest that you're receiving on these is tax-free. We'll start off on the top line by looking at a cash ISA. I think I should start by saying everybody gets an ISA allowance each year. And for those of us who are using ISAs, the allowance this year is £20,000. That's the maximum that can be put into one or a number of different ISAs. So a maximum overall figure, £20,000. And if you're putting it into cash, then the cash savings, provided they're in an authorized institution, they're covered by the Financial Services Compensation Scheme, which means if that bank, building society, or whatever went out of business, you still keep the money that you've put in and the interest that you've earned. With instant access, there are no penalties for you to move the money out. And of course, if it's an emergency fund that you're putting aside, then you're going to make sure it's instant access. And in terms of kind of return, even with instant access in ISAs at the moment, you can comfortably get more than 4%. Although I would say for instant access, you're now going to be struggling to get the 5%. As we're going to sort of suggest at the moment, the Bank of England base rate. This is the Bank of England announce a new interest rate every 6 weeks or so. That recently came down to 4.75% in November, earlier on this month, and I've got to say some of the savings rates have moved pretty quickly on the back of that. Now, I'm going to mention at this point stocks and shares ISAs just to make it clear that ISAs come in a range of different shapes, and one of them is called a stocks and shares ISA. As the name suggests, the money's not going into a cash account now. It's buying shares in companies or it's investing in other areas as well. Now, just briefly, because I'll come on to investments in a little while, but just remember with an investment, values can go down as well as going up. And whilst, the people that you're saving with are covered by the Financial Services Compensation Scheme, remember your investment losses are not covered. Okay, so this is something that instead of putting into instant access, this is money that you're likely to be putting aside for 4, 5, 6 years, maybe even longer. Um, in terms of restrictions, there are none. You can withdraw your money anytime you want. You can invest the money whenever you want within the overall ISA limit. But you do need to then keep on top of it, monitor the values, make sure you're comfortable with where you're invested, and review it from time to time. You'll see in terms of returns, yeah, they're going to fluctuate. Some years are going to be better than others, and indeed, some years you might actually see the value of your investments overall go down. But remember, it's longer term. Time is on your side, and if you're prepared to wait it out, you should see a better return with stocks and shares than you would with just putting your money into cash. Now, it'd be wrong of me if I didn't mention the lifetime ISA, or LISA for short. Now, this is a variation of an ISA. It's only available to those of you who are aged between 18 and 39. Some of you will have already got one. Those of you who haven't, this is where you can put up to £4,000 a year into a lifetime ISA. Okay, maximum of £4,000 going in. It can be put into cash. It could be put into stocks and shares if you're thinking, yeah, this is something for the longer term. The huge advantage of a lifetime ISA is that you get a government bonus of 25% on any new money that you're putting into it. So let's say this year you've not taken out a lifetime ISA, you put in £4,000 before April next year, you will get a government bonus of £1,000 added to your £4,000 saving or investment, giving you now £5,000 of value in there. Now, with the lifetime ISA, it's been set up for two specific reasons. The first is that it can be used to purchase your first home. Now, some of you, I'm guessing, have already got your first home, but you're thinking, okay, then why would I be putting money into the lifetime ISA? Because I can't use it anymore. Well, you can use it provided you stay with the plan until you're 60 years old. I know that for some of you that's going to be a long time away, but it's another form of almost retirement savings. If you stay with your lifetime ISA till you're 60 years old, you can access the money entirely tax-free. So that's the money that you've put in, the government bonus, plus any returns that you've seen over the longer period. If you access it before the age of 60, there is a 25% access charge. So please be very careful. Money going into a lifetime ISA, and if it's not for your purchasing your first home, it's money that you're putting away for the very long term till you're at least 60 years old. Now, if any of you got any questions around that, please do drop them in the Q&A section with Adrian, and he'll cover those off with you. Let's move on. I mentioned the Bank of England rate, that it's currently 4.75%. That's changed on the 7th of November. That's this month. And the good news about interest rates is when they go up, it's great news for a saver. If we look on this slide, you can see prior to 2022, yes, savings rates were really on the floor. And in many cases, you had inflation that was higher than the actual interest rate you were receiving. And for some savers, that meant in real terms, they were losing money. Since 2022, we've seen the Bank of England base rate rise. We've seen savings rates rise, which has been fantastic news, particularly when, as I'll highlight in the current moment, we've got inflation at quite a low rate, and yet we've got savings rates at quite a high rate. So some of us with savings, we're making money. Conversely, when you've got interest rates rising, as they have since 2022, this has been really bad news for borrowers. Any of you with a mortgage, you'll know that the cost of borrowing has increased significantly over the last few years. And was we starting to see a drop in the Bank of England base rate? These are still expensive times for getting hold of mortgages. So with great care on that. I'll just repeat something that we've covered in the past, but for any of you looking for mortgages or looking for help with mortgages, do contact us, because we've got a specific mortgage brokerage that we've purchased to make sure that we can give you help in that area. Okay. Short-term savings, bank, building society, that kind of thing. Longer-term savings opens the door to a whole range of things. Now, yeah, you can still keep your money in cash. It's yours at the end of the day, and you'll do with it what you want. But you could consider taking a little bit more investment risk to hopefully provide you with a greater potential return. You'll see there's a sort of ladder of risk here and a ladder of potential return too. A bond is it's debt. You know, the government issue, and the government borrow a lot of money every single month, and they issue a thing called a gilt. That's a UK government bond. And okay, for people to purchase this, the government entice them to do this by paying out a fairly reasonable rate of interest. So at the moment, government borrowing, it's paying out well north of 4%, and in some cases north of 5%. Companies issue the same things, but in those cases, to know what you're buying, you'll hear them referred to as corporate bonds. And corporate bonds for some companies will pay a far higher interest rate. And that's because government bonds are pretty secure, whereas with corporate bonds, if that company goes out of business, yeah, you might not see all of your money back. Okay. Property. I'm sure all of us have tried in the past to buy property, or we're living in one at the moment. So it's not necessarily investment, but property prices do over the course of time tend to increase in value. The other thing about property that let's not ignore the fact is if you've got, well, you've got your home where you live in, but if you've got another property and you're renting that out to other people, that property, as well as perhaps going up in value, is generating you an income as well. The final one on this list, and I'll cover some others that you might have considered in the past, and those are equities or shares in companies. Any of you who follow the stock market will see that the value of shares goes down, and then sometimes the value of shares goes up. We prefer the up rather than the down, but just to differentiate the fact that in terms of risk, yeah, equities do provide us with perhaps the greatest potential returns, but there's more risk attached to them as well. It's important whenever you're considering any of these that you're comfortable where your money's going, and you're conscious as well that, okay, with shares, perhaps with property as well, you're definitely investing for the longer term. These aren't sort of instant access things that you're thinking of doing. And that really leads us neatly into the area of investing where perhaps we're considering taking a bit more risk. And you can see on the slide there, that line is certainly going all over the place. We're not really thinking short term here. We're thinking of investing probably at least 5 years, possibly longer, 10, 20, 30 years or more, particularly if you're thinking of that lifetime ISA. Okay, now if it takes that long to get a good return, you might be thinking, well, why am I bothering to put money into investments? And the big one is inflation. Now, just to give you a slightly more updated picture than the one that we're looking at here, the October UK inflation rate was announced recently this month. The October rate of inflation was 2.3%. Okay, so you're thinking, oh, well, that's not too bad, 2.3%. It's not, but it is an increase on the previous month when in September the inflation rate was 1.7%. So inflation we see is gradually creeping up a bit, and yet we're seeing interest rates fall back a bit. An easy access savings rate in August 24, 5.2%. Easy access rates now are dipping below the 5%. So in other words, there is a narrowing between the two figures. If inflation is running at 2.3%, the whole trick is you're trying to get a rate of return better than that figure. And if you're getting an investment return that is better than 2.3%, then you are in real terms making money. So how do you make sure that you're going to make money with your investments? Well, you could consider buying a share in a company. By buying a share, you own a part of that company. This is how companies encourage us to invest. They issue these shares. The reason we put money into shares is because the company's got a stated aim, which is to make something or produce something or provide information to people or provide a service. And in doing that, they're hoping to turn our investment into greater value. In other words, the value of the company will increase. And if the value of the company increases, then the value of our share increases in proportion to it. The other thing that companies will do with the shares is look at the returns that they're making and share some of those returns with us. And they give us dividends back. So if you're a shareholder, for example, in one of the airlines, then you're doing pretty well at the moment because airlines are making money and they are sharing some of the profit with their shareholders. Now, flip that back a few years previously, and airlines were not making money. So dividends either slowed down or stopped completely. I've got to say the value of those airline shares will have dipped as well. But, we're out of a long pandemic. We're back to people desperately trying to see other places. And so, okay, this is not a recommendation to buy airline shares, but it's an industry that's doing really well at the moment. Just bear in mind, whenever you're getting into shares, investments will fall as well as rise, but you're thinking of investing for the longer term. So yeah, bear that in mind too. You're in it for the longer term. Where do you start when you're looking for shares? Well, you could start talking with stockbrokers who will have a whole range of recommendations. They're going to charge you a fee for this service, but they're going to have a fairly lengthy discussion with you to find out, okay, where are your interests? What are you trying to achieve? And they'll put one or two recommendations in front of you. If you don't want to get into that level of detail, you can invest in a fund. So you'll find a lot of fund managers will have packaged a fund together. It might actually track an index. So you don't need to think about the companies themselves. You could say, listen, I'm seeing that America is doing quite well at the moment. Could I have a fund that invests in the S&P 500? Stands for the Standard & Poor's 500, and it's top 500 companies listed on the Standard & Poor's exchange. So again, you could put your money into that, and your money with lots of other investors is being shared across this kind of index and tracks it. By doing something like a fund-based approach, you've actually diversified to an extent, because as the name suggests, if you're tracking an index, you're definitely not investing in just one company, you're investing in a number of companies. So the hope is there that some of them may well be struggling, but a lot more of them are hopefully doing very well. And it's that overall approach which means that you should, over the course of time, at least break even and hopefully start getting a better return than inflation. All of funds have to comply with regulation. The main regulator in the UK for funds and investments is the Financial Conduct Authority, or FCA, and they will make sure that if you see their names alongside an organization that you're dealing with, you know that they've been approved by the FCA, which means that they're meeting several standards and they're complying with them. Now, okay, that's funds. Let me just quickly go back to individual savings accounts, that's ISAs again, and stocks and shares. If you're thinking to yourself, well, listen, I've got, out of that 235 we looked at, and I've got 100 going into my emergency fund, what do I do the other part? And if you're thinking, yeah, I'd like to put some money aside, it is for the longer term, but where can I start? Well, you could start with a stocks and shares ISA. So again, you've got that selection route available to you, individual shares, or put it into funds. You could even put some into bonds as well. And you could start off with a monthly amount. So there's lots of stocks and shares ISAs on the marketplace. A lot of them you can start monthly. You can start as low as something like £50 a month. And your money, each £50 that you're putting in is investing in the fund that you've chosen. Now, clearly, the fund values will fluctuate. Some months will go down, some months will go up. Don't be put off by that. In fact, saving monthly or investing monthly has got one or two advantages. If you can think to yourself, well, the value of the fund looks to have gone down a little bit. Well, it does mean that your £50 has bought more of a share in that fund than it would have done in the previous month when the value has gone up. In other words, this fluctuation in value does actually benefit you over the longer term. Again, back to stocks and shares, investments go down as well as going up. So, okay, you can't be protected against investment losses, but the organization itself that's managing your money, if something happens to them, yet that your investments are secured there, okay, and the financial services compensation scheme kicks in to ensure that your funds are protected there. No restrictions about how you manage your own investments. You can do it yourself. You can pay somebody like a fund manager to do it for you. But of course, if you're using a fund manager, they'll be wanting some payment for the money that's going in there. So please be careful that you check those before you start putting your money into a particular fund. All of the fund managers that you deal with, whoever it is, will say to you, listen, we can't guarantee returns. In fact, if you hear somebody saying we can give you a guaranteed X%, look very carefully into that. It's very unusual to see people offering guarantees these days. In terms of fund choices, the world is literally out there for you to choose from. Overseas equities, meaning shares in other countries, those are shares not in the UK. Very popular areas will be Europe, America, because they're big trading areas. There's lots of companies in there. But don't forget the UK. The UK is there for you as well. Fixed interest. Fixed interest is another word for a bond. So it's where you're buying a bond or a share in a bond. You know what the value is. You're getting a rate of interest getting paid on that as well, but they're getting traded as well. So you just got to be careful that, okay, whilst more stable than shares, values can fluctuate a little bit. Hey, we all know about cash. We all know about property. Other than, I would say that if you're investing in a property fund, do check the paperwork to see, okay, what sort of property is the fund investing money in? Because there's all sorts of different properties as we're aware of, but a lot of them will be looking at commercial property. So high street, less popular than it has been in the past, but out of town shopping areas, office blocks, and more recently, buy to rent property. So a lot of funds now, if you look at places like Manchester, where it seems like every other block is buy to rent. If you're looking at parts of Leeds, where I'm sitting tonight, a lot of buy to rent suddenly, but sort of getting lifted up in Leeds to be made available, and that's an investment area that a lot of people are looking at. Multi-asset just means you're doing a mix of these. There are ethical investments for those of you who want to exclude certain activities. You might think, well, I don't want anything to do with oil or tobacco or something like that. And then finally, for some, for very strong religious reasons, they may say to themselves, listen, I want it to be compliant with the tenets of Sharia. There are Sharia compliant investments out there too. Word of caution here. It sounds like I'm telling you all the time, be careful, but it is important to think it's your money. You've worked damn hard to earn it. You want to make sure that if you're putting it somewhere, it's in a relatively secure place. Values can go down, but it's still good for the longer term. Day trading is something that I see a lot of adverts for day trading on the internet. So if you go down that YouTube hole, you'll find some adverts pop up and somebody will say, listen, we can show you there's this new trading algorithm that we've worked out, and you're able to put your money in, and we'll actually loan you money. Gosh, it gets complicated, but they'll loan you money and you can then trade it. Okay. Trading means that you're in and out of these investments in a very short time, relatively speaking. And just to give you a feel for day trading, and this is the reality, not the sales pitch that you see, eToro, one of the big online trading apps, they report that 74% of the trade transactions on their site actually lose money. So it's only 26% of actually making money. And this is on big statistics that they generate. They also report 70% of all day traders lose all the money that they've deposited with eToro in the first year. Okay, so I'm not trying to put you off. I'm just trying to highlight the fact that this is not easy. This is something that you really need to dedicate some time to. Cryptocurrency. Wow. Quite a high level topic these days. Cryptocurrencies are extremely volatile investments. I'm sure you're all aware of this. Just to give you an example, if you look to the value of Bitcoin in September this year, the value of Bitcoin was about $53,000. Okay, today Bitcoin is trading at $93,500. That's how volatile it is. And whilst, yeah, it's almost doubled in the course of a few short months for one very strong reason, which is the recent election in America, it can go down just as quickly. In fact, in 2022, the value of Bitcoin went down by almost 70% within the year. So be very wary of this. Crypto is great, and you'll hear some wonderful stories about it. But there's a lot of people losing money on it as well as those making it. So please, with care. This is money that you've got to appreciate. Yeah, it could all go. Remember the eToro figures. Be very wary as well. Anybody who's promising you a high return or a guaranteed return, how can they do it? Really, that should be a reason to pause and think, oh, hold on. How do you do this before you even commit a penny to anything like this? And then, yeah, the scams. And scams typically are easier to recognize when you start hearing phrases like, listen, this is a very short one-off offer. It's only going to be available until early December. We're running out of stock of this particular offer. And in fact, there is only 3 more of these deals available to you. Anything that you hear like that is probably somebody thinking about a very hard sell to encourage you to put your money there. And then once they've got your money, suddenly they're walking away and leaving you, ruining the day that you put the money in. So with scams, just be very careful. Take the details of the company, check them out on the FCA register before you share anything with them at all. And on that point, some of the sort of to-do list on sort of this, the FCA, Financial Conduct Authority, remember this is a regulator, do have a look at their website. It's got some very useful information. In fact, they list us, they've got a scam site where they show some of the latest wonderful offers that people are making and to walk away from as quickly as you can. It's not the most exciting of sites, I've got to say. It is a regulator after all, but worth drilling into the detail. They're also pretty good because they list all the regulated financial advisors, but there's other organizations as well. You can see 3 more on the slide there. That's unbiased, find an advisor and vouch for. There's also the very popular with a lot of people, sometimes not popular, but there's Martin Lewis, moneysavingexpert.com. So, look and maybe register for his newsletter to get a feel for what's out there and what's safe to invest in and what you would definitely be well advised to walk a mile from. So in terms of your investing to-do list, those are the sources of information. Remember, go right back to the beginning, and it's sorting out your financial goals. What am I saving for? What am I investing for? When do I need the money back? All of that helps you put together a plan for yourself individually. And at this point, I'm going to slow down and bring in Adrian, who's been sitting in the background patiently. And hopefully we can get a feel for what people have been asking about or what Adrian wants to add into the party. Over to you, Adrian.
No, I'll just ask you what people have been asking about, Mark. Good evening, everybody. Nice to see you. I am here. It's just been a long day for me, and Mark's really done a good job on taking over and presenting. So thank you very much. Just one quick question. If somebody's interested in taking control of their money more than they currently do, are there any special apps that they can use or places where they can get information from on how to balance the books?
Yeah, there are. There's lots of well, I don't know if any of you are banking with people like the new challenger banks, Monzo, Starling, those kind of people, Revolut. They've all got apps available within their service. Strangely enough, some of the more established bank building societies, they're late to the party, but they're coming in with all sorts of things. And in fact, online banking these days means that the potential for getting scammed is reduced because you can spot the scams earlier and back out of them. But separately, there are commercial organizations who will use who issue things. So I think the one I can think of is Emma, but there are others. There's Plum out there as well. Some of these apps will offer you a free service, quite a basic one, and then there'll be a monthly fee for some other ones, but it will basically analyze all of your spending, tell you where, and highlight opportunities where you might think with a little bit of work on your part, you could be saving money, spending less in that particular area. And that's the reason we use them. It's all about, okay, reduce my outgoings, get the same level of service, the same goods, but for a lower cost to give me more money to either save or invest for the future, or maybe just go out for a drink one night and enjoy it for free.
Other than that, there were no other questions. Just one final point from me. When you're investing, if it looks too good to be true, probably is. Thanks, Mark.
As is life in general. Listen, thank you, all of you. Thanks, Aid, very much for handling the questions. Thanks, all of you, for attention. If you're watching the recording, this is the moment when just take a note of my email address. If you've got a specific question, drop me a line. It's either myself or Adrian will come back to you. We both sort of monitor these questions on the back of the recordings. Again, thank you for your time. Thank you to Steve for setting all of this up and giving us the opportunity to all catch up. It feels like quite often this year, but it's been fantastic. To all of you, given this is the last one, yeah, it seems a little bit early. It is the end of November, though. So okay, best wishes for the holiday that is to come. I wish you all the very best towards the end of this year and a fantastic 2025. Just take care, look after yourselves, and have a good time. Take care. Bye-bye.